And a fresh warning sign from the US jobs market, and it could complicate the Federal Reserve's next interest rate decision. But that headline number doesn't tell the whole story. The weaker labor data is now colliding with a very different concern at the Fed: inflation that remains above its 2% target. The July jobs report came in well below expectations. Economists had forecast an increase of 80,000 jobs. Instead, payrolls fell by 23,000. The first monthly decline in 5 months, and previous data was also revised lower. The economy added 103,000 fewer jobs in May and June than previously reported. Over the past 3 months, average job growth is now just 20,000 a month, compared with 77,000 a month in the 3 months through June.
It was a soft report across the board, right? We had a contraction in headline employment, which we haven't seen for a while. We also saw soft wage growth, and we saw the participation rate fall further, and all of that on top of downward revisions to the prior months. So really softness across the board.
Now, the unemployment rate actually fell from 4.2% to 4.1%, but that is not necessarily good news, because 264,000 people left the labor force, meaning they were no longer working or actively looking for work either. And that pushed the labor force participation rate down to 61.4%, its lowest level in about 5.5 years. Wage growth also slowed to 3.2% year on year from 3.4% in June. Some sectors took a clear hit. Local government education jobs fell by about 49,600. Leisure and hospitality lost 40,000 jobs, while retail employment fell by about 19,400. Financial activities shed another 14,000 jobs. Healthcare added 22,000, while construction also added 22,000. Economists say some of the education decline may reflect seasonal adjustments, so the numbers should not automatically be read as an economic collapse. And this is where the Federal Reserve comes in. The Fed is facing two competing signals: a weakening labor market, which argues against raising rates, but sticky inflation argues for keeping rates high or even raising them further. The Fed currently has its benchmark rate at 3.5% to 3.75. Three Fed policymakers recently dissented from the decision to hold rates, preferring a quarter-point hike. Markets had been leaning towards a September hike, but after the jobs report, the probability fell to roughly 44%. So the next major piece of the puzzle is inflation data due next week. If inflation stays stubbornly high, the Fed could still prioritize fighting prices despite the weak jobs numbers. If inflation cools, the softer labor market could give policymakers more reason to hold rates.